I think the first takeaway is that there's a lot of information in the VIX that's really relevant today, especially as a measure of liquidity. The second thing that I wanted to convey was the notion that actually indices are really used in very active ways, and the evolution of the investing landscape from being more just about going from just being about stock picking to actually being about market picking, and the way that the VIX interacts with the concerns and interests and opportunities in that space. So the SKEW index is an index that's published by Cboe, but what it essentially tells you is a forward-looking indicator about kind of splitting out. What it helps you do is split out. You get two kinds of, I guess, market-moving events, right? Sometimes a lot of things are happening all at once, and there's a lot of market movement, essentially because of news, and you sort of see that coming. But there are also real surprises, and we call these tail risks. And what SKEW can help you do is it helps you unpick, is the market concerned about day-to-day volatility increasing, or is it starting to get worried about those tail risks? Well, what's particularly interesting is we've seen an evolution over the past, say, 2 or 3 years. 2017 in particular, very low VIX, but quite high SKEW. Right? So people were not really worried about the day-to-day, but quite worried about tail risks. If you look at the markets today, what you have is a higher VIX, so more day-to-day volatility, but less SKEW. It could be that people believe that the Federal Reserve will step in and support the market, so it can go down, but only not so much. It could be for a lot of different reasons. The important point is that looking at SKEW and VIX can give you an idea of the balance between tail risk and day-to-day risk. Right now, day-to-day risk seems to be the more important factor. Yeah, so one of the I guess, stylistically well-known facts about the VIX is that it tends to overestimate future volatility. And there are good reasons why that might be so. What's interesting is if you look over a really long time horizon, that overestimation has been decreasing on average. In other words, the VIX is actually getting closer as a predictor of future volatility. Now, why that might be, I put that one of the reasons could be just the increasing depth of liquidity and the increasing number of market participants who are engaged in those options markets. As a general principle, the more traders, speculators, arbitrageurs, and investors that are involved in a market, the more efficient you hope the pricing to become. Yeah, so one of the things that I thought was interesting and presented was so you have defensive equity strategies, you might call them. So it's an equity strategy, picking stocks, but maybe picking stocks that are less volatile. Now that is a factor or a strategy that's actually got a really impressive long-term track record, particularly in US equities. But it doesn't always outperform, and in particular, this sort of low volatility concept tends to underperform when the market is ripping up. It tends to outperform when the market falls. That pattern of outperforming in bad times, underperforming in good times, can be combined very effectively with volatility strategies, especially those that are kind of selling volatility or providing insurance. So we looked at the ways that strategies like that can be used in a strategic sense, combining together to give a more secure long-term performance. So speaking now just after the end of a summer where the market moved around a lot in August 2019, but there wasn't really a particular obvious reason why it should do so. And actually, if you look at it, what it's very suggestive of is essentially a bit of a liquidity crunch. Could be the summer holidays and people go trading desks leaving for the summer. But what it looked like in practice was a liquidity crunch. And actually, in terms of thinking about how much the market moves for a certain amount of volume, the real feature is how much does the market move. And in that sense, VIX is very closely associated to the notion of liquidity or the notion of how easily a market can get pushed around. So I think particularly recently, given what happened this summer, and as well what happened in December 2018, VIX is starting to really focus on or indicate the concerns about liquidity, and really index liquidity there being something that's driving the perceptions of future volatility. Yes, we've just published a new little short research piece. What we wanted to do was to essentially measure and show the degree of trading in aggregate that occurs in index-linked products. So the S&P 500 or the Dow Jones, they may have futures, options, ETFs or other exchange-traded products, but no one had sort of gone around and said, well, how much trading is there in total? And the picture that emerges is one that is interesting for two reasons. First, it kind of challenges the notion that these are only used as passive investment in vehicles. They're actually used very actively by a wide range of investors. And the second thing that I think is important is it shows you that actually the liquidity in these indices is very deep. So for those who are perhaps thinking about how and where they can express their views, an index-based approach can often have lower frictions than, say, a single stock approach. I've had the great pleasure of attending a few RMC conferences over the years. The sessions are always very interesting, but it's the discussions and the chance to meet with such a broad range of market participants, index providers like myself, exchange members, market makers, investors, pension funds, who have been brought together around the concepts of thinking about risk and risk management. So it's not just the sessions, it's also the discussions around that that make this conference a highlight for me.